Investors are digesting more earnings results of the 78 companies in the S&P 500 that reported on Tuesday. Most beat expectations. Let's get some takeaways from earnings season so far and some ideas for your portfolio from Sean O'Hara, president of Pacer ETFs. Sean, thanks very much for joining us.
Good morning. Thanks for having me.
All right. It's a busy time right now for earnings. What did you like yesterday that you saw, and what are some of the concerns?
Well, I think it's been a little bit of a mixed bag. We're still fairly early in the earnings reporting cycle. The banks have done fairly well, I think mostly, driven by, trading revenues and some increase in investment banking. There have been a few misses, as you mentioned earlier, Netflix on a miss. But I think generally speaking, going through the rest of this earnings season, I think that, we're going to see sort of more of what we have been seeing, which is far better on the upside than those that are disappointing.
And with Netflix, any concerns when you look at that? I know that it was they got hit with that tax down in Brazil. Is there other concerns that people should be watching for with that company, or is it just that one-off?
I think it's just that one-off. And I think people need to keep in mind, like the big correction in Netflix brings it back to its early October price. So it's still up substantially for the year. It's still a great franchise. There's a lot of competition for sure in the streaming world. But I still think they're sort of the king of the mountain there.
Okay, and what are you looking for? What are you looking for in the earnings that are coming up? We've got Tesla coming up after the markets close. Who else are you paying attention to?
Well, I mean, Tesla is a big one because, they're a big market cap company. I think they'll continue to sort of inch along, as, they sort of make this transition from being exclusively, a car manufacturer to sort of an AI and robotics play. And so I think Tesla's an interesting name to keep an eye on.
And the Mag 7, what overall, is there anything that might shock the market, or are we expecting a fairly decent response from all of them?
I think the big worry on the Mag 7 is that they're sort of priced for perfection, if you will. So, they're dominant in these broad U.S. market indexes. When you look at the S&P or the NASDAQ or the Russell Growth Index, they take up so much of the space in terms of the allocation of capital, because they're market cap weighted indexes. And those are the things that, we generally report on when we watch shows like Bloomberg. What we're focused on at Pacer is trying to identify names outside of the Mag 7 who have great earnings growth, great free cash flow generation, and have the ability to grow faster than the Mag 7. I sort of look at the Mag 7 and, like, since we're coming up on Thanksgiving, if you will, here in the United States, if we had a big giant Thanksgiving dinner and we set all the food on the table, but all the adults ate all the food and all the kids couldn't get any, the kids wouldn't grow, and the kids have better growth opportunities. So I think the market's sort of like that, in that right now the adults are taking all of the food, but underneath the surface, there's tremendous opportunities.
The kids' table. I have to sit at the kids' table a lot. Okay, and we're going to get to some of those choices you're looking at in just a minute. With the earnings that we're seeing, how do you see the fourth quarter going?
I think the fourth quarter is kind of setting up for continued rise in equities. I think, the environment is more important probably than anything. That, there is not a lot of pessimism out there. I mean, I think there are some risky parts of the market that you're starting to see some cracks in. But overall, I think the environment is positive. I think we're going to get another Fed cut here in the United States. I think earnings growth is going to exceed the estimates in general. And inflation is somewhat muted. The big scare we had early this year was that we would eventually, see inflation here in the United States based on the tariffs. That's obviously not necessarily been the big story. It's been less of an impact. And so you sort of put all of that together, and I think, it sets up for a pretty nice quarter for us.
Okay, and you've got some picks. Let's get into those right now. And the first one we have up is Ubiquiti out of New York.
Yeah, Ubiquiti is one of those names. It's in the Russell 1000, so it's a large cap company. We own it, and we've owned it for a long time. Big profit increase, big free cash flow generation increase, big free cash flow per share increase. They're up, as you see on the screen, pretty dramatically. We've held this stock for more than a year. It has a very, very small weight in the broad index. It has a much bigger weight in one of our ETFs, CalG. So this is an example, I think, of what we're talking about, in that everybody's focused on 7 names, and there's these smaller names in the indexes. They're not small cap stocks, they're large cap stocks, but they have tremendous, tremendous growth potential, probably more than the overall Mag 7 do. Yet, if you were a broad-based indexed investor, you're just not getting any exposure to it. And so finding ways to pair something like, a different strategy that focuses on something like free cash flow margin, which is where this one comes from, is an opportunity for investors to sort of diversify away from some of the Mag 7 without necessarily giving up the performance.
Okay, and Oracle is another one you're liking.
Yeah, so we have an ETF, TRFK traffic. It's focused on data. There's going to be something like $4.7 trillion invested in equipment in order to power this AI revolution. That equipment's going to go inside of those data centers. And so we screen for names that focus on the data transmission, storage, or manipulation, which is what AI is all about. Oracle is a big holding for us. We have had a nice run in that as well. But that what's making their stock attractive, not only from the fact that they're a solid company with fundamentals, but their forecasts going forward over the next 10 years, they see a dramatic increase in sales, and that goes with that build out. They're going to get a portion of that $4.7 trillion worth of investment in equipment.
Okay, and I want to get in one more. Lyft, I've used it the last couple of times, and they seem to be the cheapest game in town right now.
Lyft's an interesting story. That's in our small cap fund. We focus on companies that have high free cash flow margin. We don't own any names in the small cap fund that are not profitable, whereas in the broad indexes, there are quite a few names in the broad indexes, somewhere like 25 to 30% of all small cap names that don't make any money. And so we screen them out immediately. But Lyft screened in again because they have turned things around. They're now profitable. Their free cash flow per share went from a negative number to $2.50. It's up pretty good this year. Everybody talks about Uber, which we own Uber as well in CalZ, but this is in CAF, our small cap ETF. And again, not a name that a lot of people pay attention to, but using our screen for free cash flow yield, we picked up on this and we've done pretty well with it.
Okay, we're going to leave it on that note there. Sean, thanks very much for joining us.
Thank you very much for having me.
Sean O'Hara is the president of Pacer ETFs.